Hello, welcome back to our second session of this afternoon. In our first session on sources of capital funds, we have discussed about the importance of owned funds and how these funds provide a cushion to the business. Then the efforts that have been made to augment the banking regulations have been explained in detail, and then we have also dealt with the amount of stakeholdings that can be held by the government and the amount that can be raised through public issue, and it has been emphasized upon the popularity of these bank shares offered by banks among the investors. It has also been seen that the public sector and various other banks are raising capital funds through capital markets, which were earlier only held by the government. Then we have also explained you about the capital adequacy norms, the tier 1 and tier 2 capital, and how there is a scope to be funds raised through the capital tier 2 route. Then the eligibility conditions for declaring dividends, which have been prescribed by the RBI, has also been explained in detail. Then the various new instruments that have been permitted by the Reserve Bank of India. There are 4 new instruments which were also explained in detail. After having understood about the sources of funds, we will now discuss about the employment of these funds. And to discuss on this topic, we have with us back in our studios Professor P.N. Varshine. We welcome you to this session, sir. And he will be discussing with you on the topic employment of funds. So we hand you over to this session.
As you know, the main function of a bank is to lend money or to invest money, as per the definition given in the Banking Regulation Act. But the banks are not absolutely free to devote or to employ entire deposit liabilities into 2 forms of employment. They have to meet 2 very significant compulsions on them while employing the funds. These are, number 1, cash reserve ratio, and number 2 is statutory liquidity ratio. These 2 are prescribed under the Acts. Cash reserve ratio is prescribed under the Reserve Bank of India Act 42, Section 42 of the Reserve Bank of India Act, and statutory liquidity ratio is required under Section 24 of the Banking Regulation Act. Cash reserve ratio means a portion of the deposit liabilities to net demand and time liabilities of a scheduled bank is required to be maintained with the Reserve Bank of India. This percentage was 3% minimum, statutory minimum was 3%, and 20% was the maximum. Reserve Bank of India had the liberty to determine the exact percentage which the banks are required to maintain. And Reserve Bank of India was required to pay interest on the statutory cash reserve ratio in excess of the statutory minimum. That is, whatever they are required to keep with the Reserve Bank, above 3%, on that portion only, interest was payable by the Reserve Bank of India. These balances were called eligible cash balance. Now, situation has changed after the amendment in the Reserve Bank of India Act in the middle of 2006. These 2 statutory limits, that is the minimum limit, the floor limit and the ceiling limits, have been abolished. And now the Reserve Bank of India has been permitted to fix any percentage, even below 3% also, for this purpose. Second important change is that interest rate is not to be paid by the Reserve Bank of India on the balances maintained by the banks. It will affect their income also. Penalties are prescribed under the Act for non-maintenance or for defaulting in maintaining the CRR at the required level. For example, if the bank is not maintaining on a daily basis CRR, penal interest will be recovered for that day at 3% above the bank rate on the amount of the shortfall. And if it shortfall continues on the next day, then 5% above the bank rate. Now let me explain to you the procedure. CRR is to be maintained on an average daily basis, not on a daily basis but average daily basis. That is, the demand and time liabilities of the bank concerned for a fortnight start from Saturday and concludes on the succeeding Friday. During this 14 days period, whatever the liabilities are there, the average, on an average, CRR is calculated. Now CRR is calculated, for example, the CRR is calculated at 10,000 rupees, suppose. Then 70% of this must be maintained on every day. The remaining portion can be maintained on some day. And if there is a deficit on some day, this deficit can be made up by a surplus on some other day. This is the procedure which is adopted. So at least 70% of the average CRR must be maintained every day. And if there is a default in maintaining the CRR at this level, then 3% above the bank rate or 5% above the bank rate is the penalty which is imposed. And now no interest is payable. Now when this stipulation is there, this stipulation immobilizes a certain portion of the deposits. Freezes, the word is the immobilization or freezing the deposits. It means that portion of deposit goes to the Reserve Bank of India, and banks are unable to grant loans and advances or invest in securities. This percentage was till recently 5%, and it has been raised to 5.5%, which has been made effective from 7th of January this year. The purpose of immobilizing the deposits through CRR is to withdraw liquidity from the banking system. When the Reserve Bank of India finds that banks are having surplus funds with them, and these surplus funds are leading to inflationary conditions in the country, bank feels the necessity of withdrawing money from the banking system by increasing the CRR. So in the context of the recent step, we can say that when inflationary conditions were rising in the month of December, inflation was rising, government felt the necessity of, the Reserve Bank of India felt the necessity of withdrawing money from the banking system, immobilizing deposits from the banks. And this is one very significant constraint. Reserve Bank of India, as I told you, has got the liberty to reduce the level of CRR or to increase the level of CRR at any level. Second important stipulation is that of the statutory liquidity ratio. When the Banking Regulation Act was enacted in the year 1949, there were two limits also here. 25% was the maximum limit and 40% was the highest limit. The ceiling limit was 40% of the net demand and time liabilities. Reserve Bank of India here also has the power, has the authority to fix the CRR above the minimum and within the maximum. And Reserve Bank of India prescribes from time to time the level of SLR. Few years back, this was as high as 38.5%. At that time, it was felt that it should be reduced. Now, the Narsimham Committee recommended that this limit should be reduced and it should come back to the minimum 25. And hence we find that it was reduced to 25%. Now let me explain to you What is meant by SLR? SLR comprises of three things. Cash. Cash is again a wider term. Cash balances with itself and cash balances with other banks, etc. But excluding CRR. In cash balance, we don't include the balance held with the Reserve Bank of India under CRR. Then second is gold, coins and bullion. Third is the approved securities, which are essentially trustee securities, the securities in which trust funds can be invested. Practically speaking, banks invest in government securities apart from cash. They keep a prescribed percentage, or we can say a limited amount of cash, essential cash with them, say about 10% of the deposits, and rest is invested in the government securities. So we can say that 25% should be held not only in government securities, but government securities and cash balances with itself and with other banks also. Now, very recently, about 2 days back, Cabinet has approved an amendment in the Banking Regulation Act, and this is expected to be introduced through an ordinance. An amendment act amending the Banking Regulation Act is before the Parliament. It contains certain proposals which have become controversial proposals. So, still the Banking Regulation Act, Amendment Act has not been passed by Parliament. So, government felt the necessity of amending the section relating to statutory liquidity ratio. So, as I told you, 2 days back, the Cabinet has approved an amendment to the Banking Regulation Act through an ordinance. And this amendment will take away these floor limits and ceiling limits from the Act itself. I think this ordinance is going to be promulgated shortly, and when it is issued, Reserve Bank of India will have the liberty to reduce the SLR to a lower limit. What will the effect of lowering the SLR? Why a reduction in the SLR is required? A reduction in the SLR is required to reduce banks' investment in government and other approved securities. Now, two important reasons have been pointed out for this reduction. First is pointed out that government does not need funds more. More funds are not needed by the government because of the larger revenue in the form of taxes. It has raised taxes to a large extent this year. It has mobilized a large amount as taxes, and so the need for depending on the capital market, on borrowings, public debt has been reduced. So the government securities would not be available in the market. Government will not be issuing large amount of securities in the market. So banks will not be able to invest in the government securities. This is one very important point. Second point which is pointed out is that the demand for bank credit is increasing. The deposits are not increasing to that extent. About 30% is the increase in the bank credit, and about 20% is said to be the increase in the deposits. So banks are in need of funds, while government is not in need of funds. Commercial houses, business houses are in need of funds which they require from the banking system. So banks should release funds from government securities and invest in advance and grant advances to business and industry. This is the purpose behind this. Well, anyway, when this amendment takes place, it will give an opportunity to the banks to divert the resources from government securities to advances, loans and advances to business and industry, and their need will be fulfilled. After meeting these two requirements, banks are at liberty to invest their funds in securities and to grant loans and advances. When we say invest in securities, and securities are part of the statutory liquidity ratio, we mean securities which are covered under Section 24 of the Banking Regulation Act and securities which are not covered under Section 24 of the Banking Regulation Act. In other words, banks' investments fall in two categories. Number one, SLR investments. SLR investments are largely in government and other approved securities which meet the requirement of Section 24 and which we have already discussed. Then they are permitted to invest in other securities also, other instruments also, which are called non-SLR investments, and these non-SLR investments are not counted, investment in these securities are not counted as SLR investments. Banks are free to invest or not to invest in these securities. These are shares and bonds, debentures of the corporate sector, plus the commercial paper issued by the corporate sector. So we can say, mainly we can say these are the corporate securities. So corporates in the investment in the corporate securities is about 1/5 of the total investments of the banks, and 4/5 of the investments are in statutory liquidity requirement SLR securities, SLR investments. This is the broad division between the two.
So can we say that after this amendment, the investment in corporate securities will be more?
No.
By the bank?
For that purpose, I am coming to the capital exposure norms.
Okay.
When the Reserve Bank of India has permitted the banks to invest in the corporate securities, it does not mean that they can invest to an unlimited extent. Reserve Bank of India has prescribed the capital market exposure limits or exposure norms. All and the aggregate exposure, the total exposure of the banks to the capital market is subject to these norms. In other words, you can say how much they can invest in the corporate securities, number one, or how much they can invest in corporate securities related in advances. The advances which are meant for, which are either against corporate securities or which are for individuals to purchase corporate securities or to brokers, share brokers, or etc., which are related to corporate securities, they are subject to a limit.
Okay.
So we can say that the Reserve Bank of India has permitted the banks to invest in what we call non-SLR investments, but these non-SLR investments are subject to exposure norms. Exposure norms means the maximum amount which they can invest in the securities is prescribed. Within those limits, the banks are free to invest in the corporate securities. Now, let me explain to you the exposure norms. These exposure norms have recently been revised, and they will come into effect from 1st of April 2007. That is still after 3 months they will come into force. But at present, what is the exposure norms? Exposure norm is that the bank's exposure to all forms of capital market. All forms of capital market means investment in the corporate securities and advances against corporate securities or advances to brokers, individuals for purchase of securities or for carrying on the capital market operations. There are two sides. So total exposure to capital market was limited to 5% of total outstanding advances as on 31st March of the last year. That is, 5% of the advances can be granted in the form of capital market exposure. Within this limit, investment in shares or convertible bonds or debentures and investment in equity-oriented mutual funds should not exceed 20% of its net worth. So, a maximum limit was prescribed, which was related to total advances of the 31st March of the previous year. Within this overall limit, a sub-limit has been prescribed, and this sub-limit is meant for or is applicable only in case of direct investment. Direct investment by banks in corporate bonds or convertible debentures, shares, bonds, convertible debentures, and mutual funds which are equity oriented. Equity oriented means larger amount of funds are invested in equities. This was limited to 20% of the net worth. So just see that the rationale of limiting to net worth. Net worth means the protection which is granted, the safety is against net worth. If your net worth is higher, you can go for higher level of investment in equity shares or equity related shares. Now, it has been changed. These two limits have been changed now, or will become changed, will be changed. Aggregate exposure, fund-based and non-fund-based, not to exceed 40% of its net worth as on 31st March of the previous year. 40% of the net worth of the previous year. And direct investment within the overall 40% limit in shares, corporate convertible bonds, debentures, units of the equity-oriented mutual funds, and all exposures to venture capital fund should not exceed 20% of the net worth. Now you have to note this difference. That both of these limits, the aggregate limit of exposure to the capital market as well as the sub-limit for direct exposure to the capital market, both these are now related to the net worth of the, net worth means the capital, paid up capital and reserves, free reserves of the bank concerned. So, within these limits, banks are permitted to invest in the corporate securities, also mutual funds also, and in the commercial paper also. Now, about investment in the non-SLR investments, there is a prohibition. Unlisted non-SLR securities should not exceed 10% of their gross non-SLR investments. It means unlisted, which are not listed in the stock exchange. Listed is the stock exchange and unlisted is the stock exchange. Unlisted securities should be not exceed 10% of the total SLR investments, and unrated non-SLR investments should not be there. They have been barred. They have been prohibited to invest in unrated. Rating, this is different. Unlisted and unrated, they are the two different things. Unlisted means which have not been listed at the stock exchange for trading. Unrated means which have not been rated by a credit rating agency. And as you know, commercial paper and debentures, bonds, debentures, etc., the debt instruments of the corporate sector are to be rated by the credit rating agencies. So, if they are not rated by the credit rating agency, then these securities cannot be held by the commercial banks as non-SLR investments. An extra 10% for securitized paper. Securitized paper means the paper, or we can say the instruments issued as a result of securitization of assets, loan assets. I will explain.
Can we know a little bit about securitization of assets, so they get a background about it? And then
No, I will discuss in the next session, the securitization of assets. Now, you know, the investments, I told you the investments are in the corporate sector and in the government sector, government securities and the approved other approved securities, especially these securities issued by semi-government organizations, autonomous bodies, etc. They are called the SLR investments. Non-SLR investments, corporate securities, largely the bonds, shares, bonds, etc. Reserve Bank of India has the power under the SLR requirement, under Section 24 of the Banking Regulation Act. Reserve Bank of India possesses the power, the authority to prescribe the method of their valuation, how they are to be valued in the books of the banks. Now, for this purpose, Reserve Bank has divided the securities into three categories. One, which are held to maturity, which will be held up to the time of maturity. So Reserve Bank says that these securities need not be marked to market. That is, the market value is not to be taken into account. The acquisition cost, the cost price, you value them at the cost price, and if the cost price is larger than the face value, then the premium is to be amortized over the remaining period of the security. That is held to maturity means if you have purchased certain bonds which you intend to keep till the date of maturity. This is held to maturity. Now, this security is not to be valued at the market price. Whatever price you have paid, suppose you have paid 100 rupees security, you have paid 110 rupees. So you value at 110 rupees. And this 10 rupee premium which you have paid, this is to be amortized. This is to be reduced yearly by debiting to profit and loss account. This is category number one. Category number two is held for trading. These securities which are intended for the purpose of trading by taking advantage of short-term price and interest rate movements are classified under held for trading. Second category is to be traded. When you find that the price rises or some advantage is there, interest rate advantage is there, or the price advantage is there, you may sell it. Now, these securities are to be marked to market at the end of the year or more frequently, at more frequent intervals. And here, the principle which is laid down is lower of the acquisition cost or the market value, whichever is lower. The general principle is the cost price or the market price, whichever is lower. So that principle will apply to the held for trading securities. And the third is available for sale. These securities which do not held for trade and available for sale, these securities, remaining security which do not fall in one category or the other category, they fall in this category, and for this category they have prescribed different basis. General basis is cost or market price, or value at an appropriate yield to maturity basis. There are the two systems which they are prescribed in case of the different types of securities. Some of the securities are to be valued just like other category, that is the acquisition cost or the market price, whichever is lower. And in some cases, they say that the yield to maturity basis. What is the yield? What yield they are giving? And what is the requirement? What is the guidelines? If the yield is lower, then they are to be valued at a lower price. And if the yield is higher, they should be valued at a higher price. So what we find is that the investment made by the banks, both SLR and non-SLR, they are to be classified into these three categories. And the first category should not exceed 25% of the total investments. Held to maturity should not exceed 25%. Rest of them are divided into these two categories, further two categories, and they are to be valued according to the Reserve Bank's guidelines. As I told you, investment fluctuation reserve has been created to meet the risks involved, and risks are two risks, either the interest rate risk or we can say the market risk. The market price may go down, or the interest rate may go up or go down, and thus affecting the market price. Today's paper says that the bond prices have fallen by 2%, 2 rupees. And the main reason is this, the SLR stipulation. The banks fear that the SLR will be reduced, and then there will be no demand for such securities, so the prices have fallen. Then we come to advances, which is very important category. Banks are free to grant advances. Of course, Reserve Bank of India is the controller of credit. Reserve Bank of India had adopted in the past several methods to exercise control over the advances granted by banks. To be brief, I would like to say that earlier there was the what we call the selective credit controls. Very minute controls were prescribed by the Reserve Bank of India, selectively on certain advances. Certain securities will carry this sort of margin, this rate of interest, this sort of aggregate limit, etc. They are no more in use now. Then came the Tandon Committee norms and Chori Committee norms. They prescribed the maximum permissible bank finance for a particular individual firm. Now, those norms have also been withdrawn. They have also been abolished. Then we find there was a compulsion that certain portion of the advances should be in the loan form, certain portion should be in the cash credit form. See, cash credit versus loan, this compulsion was introduced by the Reserve Bank of India. That has also gone. Now, what is the method employed by the Reserve Bank of India to exercise control over we can say the quantum and quality of advances granted by banks? The Reserve Bank of India's concern is that banks should grant advances which do not involve them in greater risk. And risk is involved in case of the unsecured advances. Risk is involved in which in the advances which are granted in large amounts to certain individual. That is excessive credit flowing towards certain firms or certain individuals, certain borrowers, that is also harmful. To certain speculative activities, for certain speculative activities, advances flowing to certain speculative or highly risky activities should also be discouraged. So, keeping in view these objectives, Reserve Bank of India has adopted the new method. And the new method is prescribing prudential norms, exposure norms. Limits have been prescribed. Certain prudential norms have been prescribed, and the banks are permitted to observe those norms and then grant credit.
We would like to remind our students once again that if they have any queries related to a previous session as well as this session, they can keep sending us the queries.
Yes. For example, exposure limits have been prescribed. Exposure limit, credit exposure limits. Credit exposure limits means how much they can grant, a bank can grant credit to a single individual or to a group of borrowers. For a single borrower, the exposure limit is 15% of the capital funds, tier 1 and tier 2 together, both total capital funds, 15% can be granted to a single individual, and 5% extra for infrastructure loans. This is the maximum limit prescribed for an individual borrower. For a group of borrowers, suppose certain borrowers belong to a certain group, then the limit is 40% and 10%. 10% is for infrastructure. And in exceptional cases, they can be increased by 5% extra. So, you will find that this exposure norm prescribes how much the banks can grant to a single individual. This is related to the tier 1 and tier 2 capital, the net worth of the bank. How much 15% of the capital funds they can prescribe, they can employ or they can grant to a certain individual, and 40% plus 10% for infrastructure they can grant to a group borrowers, to the group of borrowers. Now, for unsecured advances, earlier there were certain limits, but they have been abolished. Now the board of directors will have to decide their own policy, and the banks are required to make additional provision of 10% on total outstanding advances in substandard category to cover expected losses. This is another dimension of the credit policy. Banks are required to classify their assets into 4 categories: standard assets, substandard assets, doubtful assets, and the loss assets, on the basis of certain parameters. And then for each asset they have to maintain a provision. They have to make a provision. So if they are subject, if a loan in a certain category is subject to a higher provision, what does it mean? Bank is not denying the Reserve Bank is not denying the banks not to grant advances to certain category of borrowers or certain purposes, for certain purposes. But the Reserve Bank says that if you grant loans to certain borrower or for a certain purpose, then you will, and this is unsecured advance, and this falls in the second category. If you categorize it in the substandard category, then you have to maintain an additional provision of 10%. For the substandard category, 10% is the provision. 10% of the advances should be as a provision, plus additional 10% you have to make. Thereby, if additional provision is made, then it means then your profits are reduced. This amount will be taken out of your profit, it will be charged to your profit and loss account, and this will be kept as a certain reserve for doubtful debts or bad debts. So in case of the unsecured advances, there is no limit. Now, banks have to decide to whom they have to give, to what extent they have to give. The Reserve Bank stipulation is that if such an unsecured advance is categorized as substandard advance, then not only 10%, but 10 plus 10, 20% provision is to be made on such substandard advances which are unsecured. Now here let me clarify these terms: asset classification and provisioning. Banks are required to classify their advances into 2 categories, mainly 2 categories: standard assets and non-performing assets. Standard assets means those assets which do not create any normal, more than the normal business risks. They do not carry more than the normal business risk. No problem, no special problems are created. They are called the standard assets. But once interest and payment of principal is overdue for 90 days, at present it is 90 days or 1280 days, if you are not able to receive interest or principal amount when it falls due for 90 days, it becomes a non-performing asset. And non-performing assets are again subdivided into 3 categories: substandard assets. Immediately from standard assets it will become substandard assets, and if it remains in the category of substandard assets for 12 months, that is, you are not able to realize interest and principal amount for 12 months, then it becomes a doubtful asset. And lastly, it becomes a loss asset when the loss is identified by the bank or by the internal or external auditors and amount is not wholly written off. So Reserve Bank's guideline says that if the asset becomes a substandard asset, then you create a provision of 10%. If it is unsecured, then 10 plus 10%. If it is a doubtful asset, it becomes a doubtful asset, then for the unsecured portion 100%. For the secured portion, you have to create provision for 20%. If it is doubtful for 1 year, for 30%, for 60% to 100%, it means from 20% to 100% according to the period for which it has been doubtful, it remains doubtful, you have to create.
So for standard assets also there has to be a provision?
Yes, yes. For standard assets, earlier in the beginning there was no provision, no requirement of any provision. Later on, a provision of 0.25 was introduced. With effect from November 2005, it was raised to 0.40%. But exceptions were direct advances to agriculture and small and medium enterprises. These two types of borrowers were still subject to 25%, otherwise 40%. And later on, it was raised to 1% in certain cases. 1% of the advances in the standard category.
Yes.
For example, personal loans, loans for capital market exposures, which I have already explained. Third, residential housing loans up to residential housing loans for 20 lakhs of rupees, up to 20 lakhs of rupees, and commercial real estate loans. All these four categories of loans were categorized as risky loans, and they were subjected to 1% provisioning even in the standard asset ratio category. The effect I have already told you. Once an advance is given, for example, as a real estate loan. Real estate loan is a somewhat risky loan. Commercial speculative activity will arise. Or immediately it will be subjected to 1%. Immediately your profit and loss account will show higher provisioning for this purpose, and your profit is reduced to that extent. So banks will be cautious in granting larger amount of loans as commercial loans or as personal loans or loans for capital market exposure. While those which are not subject to higher provisioning, like agriculture and SME, small and medium enterprises, these loans would be encouraged because a lower provisioning is required. In case of agriculture, small scale industries, lower provisioning is required. In case of housing loan, real estate loans, consumer loans, personal loans, higher provisioning is required.
So for loss assets it will be?
In case of the loss assets, 100% of the outstanding amount, whole amount is to be shown as a provisioning. Either you write it off, either the whole asset is to be written off. This is one thing. Or if you keep in the books, then make a provision of 100% provisioning. Here the provision is that provision on standard assets will be eligible for inclusion in Tier 2 capital up to permitted levels. This is the we can say relief given to the banks, that whatever provisioning is made in case of the standard assets, that is included in Tier 2 capital, and that meets your capital adequacy requirement.
With this we come to the end of this session. If there are any points to be if you have any questions related to our first two sessions, you can you can send these questions even in our third session, because we will have Professor Varshne with us in the third session as well. So do join us at 1 o'clock. Till then, stay tuned.